So what we're going to explore here is called cost volume profit analysis. And I just want to talk about some of the fundamentals. It's really one of my favorite concepts to teach, and I think it's potentially one of the most useful concepts when you're making forward-thinking managerial business decisions. Now, you probably are familiar with an income statement that looks like this, a traditional layout according to function. So, as a reminder, the income statement covers a period of time. So this is the entire calendar year of 2018, January through December. And it describes functionally the sales revenue we earned minus the cost of goods sold required to produce those sales. That brings us to a subtotal called gross profit. Subtract our selling general administrative expenses, and we have a net operating income of $100,000. That's the way you would see the income statement formatted for external reporting, for financial accounting. A lot of times for managerial accounting, we prefer a contribution margin format. Now you'll notice it's the same bottom line net operating income. Profit is profit, and it's covering the same period of time. But instead of organizing our costs or our expenses by function, we instead organize them by behavior. We put all the variable expenses together and lump them in. The subtotal, when subtracted from sales revenue, is not gross profit anymore. It's something called contribution margin. And then from the contribution margin, we subtract our fixed expenses. Now remember, as long as we stay within the relevant range, those expenses should be expected to be fixed with activity. So if activity increases, the fixed expenses should stay the same. They may not be exactly the same. Remember that we are always trading a bit of accuracy for relevance and timeliness with managerial decisions, but largely they should stay fixed. So now we have the building block for figuring out things like where would we break even? In other words, where would the profit be exactly zero? Or what if we want the profit to be $150,000 instead of $100,000? What do we need to do to get there? A lot of times I refer to cost volume profit analysis as the what-if analysis. If we do this, what will happen? So let's take a look over here. Same contribution margin income statement, but we're at the break-even point. So this is this magical point of activity. In this case, since it's a pizza restaurant, if we sell 17,500 pizzas, then we're going to generate just enough contribution margin, $140,000, to cover our fixed expenses. No more, no less. And that doesn't provide us with a profit, but at least we're not losing money. At least we're not generating a loss at this level of activity. Now, the break-even point is useful to know, but why should we just settle for breaking even? So we don't want to just break even. Of course, we'd like to generate a profit. Now, I'm going to show you in a minute how we can calculate that. But let's take a look at this break-even analysis graphically first. What you have here, the yellow line, this is your total cost line. And you'll notice if we sell 0 pizzas, so right here, we're selling no pizzas, big goose egg, our total costs are still $140,000. And that's because our fixed expenses are $140,000. If you don't sell a single pizza, you still have to pay your rent, your insurance premiums, probably a salary to a manager of the store, things like that. So those fixed costs are going to exist within the relevant range regardless of whatever activity we have. So that's really the jumping off or the starting point for our total cost line. So this total cost line increases at a rate of our variable costs. Okay, variable cost per unit. That's going to be the slope of that line. Now, the blue line here, this is our total revenue line. And the thing about total revenue, it's a little bit different than our total cost line. If we don't sell any pizzas, guess what our total revenue is going to be? 0. So no pizzas, no revenue. That's why this whole area, this triangle kind of right here that I'm outlining, that's our loss area. Now the loss area starts to get thinner and thinner, which it should, as total revenue approaches total cost. And the break-even point is this magical 17,500 pizzas, which gives us just enough contribution margin to cover our fixed expenses. So that's our break-even point. But we would really like to see this happen. Since the revenue is going up at a rate of $20 per pizza, and the total cost is increasing at a rate lower than that, then past the break-even point, the revenue will continue to increase, and the total cost certainly will increase. You have to spend money to make money, but they increase at a lower rate, allowing us to generate the profit that every business seeks to generate. So now let's take a look at how we can determine that quantitatively as we look at some calculations. Who wants to just break even, right? So remember at 17,500 pizzas, we were exactly at the break-even point. Now take a look over here. We can express our revenues and our expenses in total. We can also do it on a per unit basis. So if our revenue is $20 per pizza, and the variable expenses like variable labor and ingredients are $12 per pizza, we get this wonderful little tool called contribution margin per unit, $8 per pizza. So if fixed expenses stay fixed within the relevant range, and we sell one additional pizza beyond the break-even point, that one additional pizza should generate $8 in additional contribution margin, which means that our contribution margin goes from $140,000 to $140,008. And if the fixed expenses stay the same, operating income will increase by the unit contribution margin. So this unit contribution margin is a basic building block of cost volume profit analysis. Knowing the per unit sales, the per unit variable expenses, and the per unit contribution margin will help us to determine things like break-even points and target profit levels of activity. Now, one of the things we can do is also calculate the contribution margin ratio. And what we're basically doing here, it's not complicated math. All we're doing, and you can do this on a total basis or you could do it on a per unit basis, but essentially, let's take a look at our contribution margin. So total contribution margin was $240,000 when we sold 30,000 pizzas, and the revenue was $600,000. That gives us a contribution margin ratio of 40%. So what that's really telling us is that for every dollar of revenue we earn, we can plan on generating 40 cents of contribution margin. Every dollar of revenue gives us 40 cents to cover these fixed expenses. So remember, cost volume profit analysis, sometimes I call it the what-if analysis. So what if? We know the break-even point is 17,500 pizzas. So the question is, what kind of profit will we generate if we sell 20,000 pizzas? So it's an additional 2,500 pizzas. Sometimes we might say it's an incremental increase. So 2,500 pizzas there. And how much additional contribution margin will we generate? Well, one way we could do it is we could take that unit contribution margin. Remember from previous calculations, contribution margin is $8 per unit. And if we sell an extra 2,500 units or pizzas, I guess I'll keep calling them units, probably make you less hungry for pizza if I do that, huh? That means that we're going to have an incremental contribution margin of $20,000. Let's see if we can prove that to ourselves here. So sales revenue went from $350 to $400. Variable expenses, those are going to go up at a rate of $12 per pizza. So those are going to increase from $210 to $240. And indeed, the contribution margin did increase by $20,000. The fixed expenses, they behave the same way as within the relevant range, they stay fixed. So whether we sell 17,500 pizzas or 20,000 pizzas, we can expect these costs to stay the same within the relevant range. Okay, in fact, I should actually say that's equal, not equal. Okay, what I meant to say was there's no change there. So fixed expenses stay the same, and contribution margin goes up by 20,000. That's why we can see this operating income increasing by 20,000. Now, what if we want to use the contribution margin ratio? Let's say that, okay, we don't know how many pizzas that really is, but maybe we know that the revenue will be 400,000. Think about a pizza restaurant, okay? They don't just sell pizza. They sell wings and salads and breadsticks and beverages and all sorts of things like that. So it may not be practical for a pizza restaurant to really quantify a unit contribution margin, so many dollars per pizza, so many dollars per salad. Instead, they may choose to average. They might say, well, we know that anticipated revenue is $400,000. And we know that on average, our unit contribution margin is 40%. So that we know on average, that should provide us with a total of $160,000 of contribution margin. So if you don't have all of that per unit information available, what you can see is that we can still generate an estimate of total contribution margin at that particular sales activity level using the contribution margin ratio. For every dollar, we expect to generate 40 cents of contribution. $400,000 times 40 cents per dollar gives us $160,000 of contribution margin to go toward covering those fixed expenses. Cost, volume, profit, what if analysis. So what if we advertise more? So annual advertising expense, we're gonna invest $60,000 into advertising. And if we do that, we think we will sell 5,000 extra pizzas. The question is this a good idea or not? One of the ways you can answer the question is to simply create comparative side-by-side contribution margin income statements where at 30,000 pizzas, your sales will be 30,000 times 20. 35,000 pizzas, 35,000 times 20 is 700,000 of revenue, et cetera, et cetera. So we could create two side-by-side full-blown income statements, and you will see the bad news here is that will cause, if this happens exactly as we predicted, this would actually result in a lower operating income because yes, sales go up, variable expenses go up, and so does contribution margin. But contribution margin is only going up at a rate of $8 per pizza. And we would have to sell enough pizzas to cover this increase in fixed costs because what's happening is our fixed costs, well, the relevant range may have changed a little bit there, right? We have different assumptions at a very minimum at least, that fixed costs were going to be $140,000, now it's going to be $200,000, okay? So the question is this, if we just use the unit contribution margin ratio, extra 5,000 pizzas, contribution margin per unit, I may have said contribution margin ratio, it's the unit contribution margin. Contribution margin per unit is $8 per pizza. So that's going to give us an extra $40,000 in total contribution margin. And it doesn't take too much math to figure out that generating an extra $40,000 of contribution, but spending $60,000 to get there is going to produce a decline in operating income. So yeah, we got more pizzas sold, we earned more revenue, earned more contribution, but the cover charge to this party was $60,000 and we only got a $40,000 benefit. So all other things being equal, we would probably say that this is not a desirable move. Now, of course, we want to question non-financial factors and things like that, but at least on the surface, it should cause us to question whether or not this is a good decision. More questions we can answer using cost, volume, profit analysis. What if we need to replace this oven? You know, that could easily be well in excess of $40,000. So can we afford to do so? Well, let's take a look at it two different ways. If we spend $43,000 to purchase an oven and every pizza gives us $8 of contribution margin, then essentially we would need to sell 5,000 375 pizzas to generate enough contribution margin to pay for that oven. Another way to look at this is to take a look at the dollar investment, $43,000, and then let's divide by the contribution margin ratio. Remember that 0.4 or that 40%? So what we can do with this is we can say, all right, we need to generate sales revenue of $107,500. So the answer to this question is, can we afford to spend 43 grand to buy a pizza oven? And the answer is, well, do you think that we will generate at least sales of 5,375 pizzas? Or alternatively, do you think we would generate revenue of $107,500? Now remember, that would just be breaking even on this investment. If we spend 43 grand on an oven and we generate $107,000 of sales revenue, then that is paying for the oven, but we obviously want to go far beyond that point and actually generate a profit. What if we're not happy with that $100,000 of operating income? What would we have to do to be able to earn $150,000 of operating income? Well, we can answer that question. This is called a target profit analysis. So we know that at the break-even point, our fixed expenses are going to be our fixed expenses no matter what. But at the break-even point, we will generate just enough contribution margin to cover these fixed expenses. And we're not satisfied with that. What we want to do is we want to earn $150,000 of profit as well. So what we're doing here is we're basically saying, how much contribution margin do we need in order to accomplish that? And the answer is we need $290,000 of contribution margin. It's our fixed cost plus profit beyond that. So if we generate $290,000 of contribution margin, that will cover our fixed expenses of $140,000 and go beyond the fixed expenses to give us $150,000 that drops to the bottom line. Well, let's quantify this in terms of pizzas or in terms of revenue. So if we know that we're looking for $290,000 of total contribution margin, and the contribution margin per unit is $8 per pizza, that means we have to sell 36,250 pizzas to get the job done. Now, of course, we might not be able to quantify it in terms of just pizzas. I mean, even in this picture, you can see there's a pizza and a beverage. And also could have been some breadsticks or salads or something like that to go with it. So what if we say, okay, how many sales dollars do we need? That's where the contribution margin ratio comes in. So we divide by the contribution margin ratio of 40%, and that will give us a target of sales revenue being $725,000. So in a multi-product setting, where you have a mix of products and maybe you can come up with an average contribution margin ratio, but it may not be appropriate to look at it per unit, you can easily figure out that we need to generate roughly $725,000 of sales revenue in order to generate $150,000 of profit. Now, accountants are professional skeptics, so some of you might be saying, prove it to me. Well, okay, fair enough. Here's an income statement, 36,250 pizzas. Okay, that matches up with what we determined over here. And at a rate of $20 per pizza here, so this is $20 per pizza. And the variable expenses were $12 per pizza. We've been working with this $8 per pizza quite a bit over here. We would generate $725,000 in sales revenue, which you'll note does match this calculation right here. And we would generate contribution margin of $290,000. That was the goal that we set up. And $290,000 minus $140,000 gives us that $150,000 of operating income. So you certainly can perform these analyses using full-blown income statement analysis, but you can also get a pretty good back of the napkin, quick and dirty, by using either the unit contribution margin to come up with the number of units, or the contribution margin ratio to come up with the amount of sales revenue needed to get the job done.